Hi everyone, good evening. Welcome to the weekly market wrap up by SECURITIES. I'll quickly take you all with the key market events that have happened in the week that went by. So starting off with the main and the most important event that happened today, the RBI hiked the policy repo rate by 50 pips again, and the repo rate stands at 5.9% as on today. This hike came into consideration, taking into the inflation numbers which were on a higher side, and the RBI continued the withdrawal of the accommodative stance that was taken earlier. This hawkish stance is a move to align with the evolving global market conditions, the geopolitical shocks, the supply side disruptions, and a lot of the uncertainty regarding the inflation environment across the globe. This rate hike that happened today, takes the total tally to 190 bips, and it takes the repo rate back to the 2019 levels. So since May of this year, the rate hike started off, right? At 4% was the repo rate, and today the repo rate stands at 5.9%. So the total tally of the repo rate has been 190 bips. The inflation is expected to be in an upper, target range in Q2 and Q3 of this fiscal. And because of which, the inflation trajectory for FY23 has been retained at 6.7%, whereas the real GDP forecast has been reduced from 7.2% earlier to 7% for the current fiscal, assuming the crude oil prices are at $100 per barrel. So the key macro data shows that the repo rate stands at 5.9. The reverse repo has been remaining unchanged at 3.35, SDF at 5.65, MSF at 6.15, cash reserve ratio at 4.5, real GDP at 7, CPI at 6.7, and 10-year GSEC is indicative in the range of 7.3. Coming towards the spread between the US Fed fund target rate and India repo rate. So historically, the 10-year average spread has been in a corridor of 550 to 560 basis points. So as you can see in the chart, the US Fed fund target range as on today, stands at 3 to 3.25%. Whereas over here in India, this repo rate as on today stands at 5.9%. So currently the spread between both of these benchmark rates is 265 bips, and hence any increase in the US Fed repo rate will have to have a simultaneously increase back here in India, and RBI will have to rise rates accordingly. Coming to the Fitch ratings, recently released by the Fitch group. So according to Fitch, the real GDP for India is going to be the highest among all the major economies across the globe. In 2022, it is expected that India will be growing at 7%, whereas in 23 and 24, Fitch expects India to be growing at 6.7 and 7.1% respectively. Now, INR has been depreciating compared to US dollars, but if we compare this to a lot of emerging economies, so INR fairly stands at a very positive rate compared to the emerging market economy currencies. Now looking at this chart where the US dollar has appreciated by 14.5%, INR at the other hand has depreciated only by 7.4%. Right, so this shows the strong resilient domestic economy that we are as on today. The equity markets kind of went by negative for the week because of a lot of macro concerns hovering around the markets. Financial sector is expected to benefit from the interest rate hike, as ultimately they are able to pass on the costs to the final consumer. Our outlook remains remains in the range bound, in that we expect that India will continue to have good tailwinds, which includes strong credit growth, real GDP growth, GST collections, PMI numbers, forex reserves, resilient agriculture sector, India has the lowest external debt to GDP ratio, and the country has strong domestic and stable macro indicators compared to peer economies. So, to achieve positive real interest rate, right now inflation stands at 7%, whereas the repo rate stands at 5.9%. So the gap, which is the negative rate that we are in, so this gap will be closely monitored, and that will make sure that it will turn the tide for the economy when it turns to a positive trajectory. So we believe that the RBI will make sure that there's a efficient management of the yield curve, and making sure that there's long-term growth rate coming in for the economy. Thank you so much.